What's going on, guys? Welcome back to the channel. My name is Mark and this is Entrepreneurial Finance. Okay, so in today's video we're going to try something a little bit different. You're not going to actually see me in this video. It's going to be completely edited so that you're looking at pictures or videos the entire time. But in today's video we're going to be talking about the cruise lines and their earnings reports for Q1. So as many of you probably know, the cruise line industry has been getting absolutely crushed on the stock market. For the most part, this is likely justified since absolutely nobody is going on cruises currently due to the COVID lockdown measures. Even as quarantine measures are eased, these companies aren't expected to return to service until at least August. Many of these companies have rushed to raise liquidity with concerns about their business model moving forward. So there's three main cruise line companies. You have Carnival Cruise Lines, Royal Caribbean Cruise Lines, and Norwegian Cruise Lines. In this video, we're going to go through each company's earnings reports, discuss the results or the upcoming results, pick my favorite of the bunch, and ultimately give my opinion on whether or not you should be buying into cruise lines currently. Okay, so first things first, let's take a look at the price of these companies. So here's the thing. All three of these companies have basically never traded this low, or if they did, it was for a very brief time. So all three of them have lost about 70 to 80% of their value year to date. Is this justified? That is the real question, because the market is now pricing in the risk of bankruptcy. If these companies are able to survive this period of uncertainty, there's actually a good chance they're probably undervalued. However, they're raising a crap ton of debt right now at ridiculous rates. I believe I saw something that Carnival Cruise Lines is raising something like $17 billion at an 11.5% coupon, which is extremely high. You know, think of it this way: when you go and buy a house and you get a mortgage, your mortgage is anywhere from like 2 to 7%. And these guys are paying 11.5% on $17 billion. They're raising debt at ridiculous rates, which may hold them down for a longer period than usual. A very common measure of a risk is beta. So beta measures the stock's volatility against that of the general market, and anything higher than 1 is considered riskier than the broader market, where everything underneath 1 is considered less risky than the broader market. As you can see, all three of these companies have betas well over 1. Norwegian Cruise Lines being the highest at 2.77 and Carnival Cruise Lines being the lowest at 1.96. Norwegian Cruise Lines is also the smallest of the three companies with a market cap of 2.8 billion, while Carnival Cruise Lines is the largest with a market cap of just under 10 billion. One other measure of value to look out for is the price to earnings ratio, and the price to earnings ratio measures the company's earnings per share against the price of the stock. It is used in relative analysis to see which company is potentially the most undervalued in its peer group. Okay, so all of them actually have pretty close price to earnings ratios ranging from 4.18 to 4.67. Royal Caribbean Cruise Lines is the lowest at 4.18 and Carnival Cruise Lines is the highest at 4.67. To put that into perspective, the average price to earnings ratio on the S&P 500 is 20.53. So these companies are trading well below the S&P historical average. Now, granted, there's many other industries on the S&P 500, but just to kind of put it into perspective, it's trading at 25% of the average price to earnings ratio on the the S&P 500 index. Now that we've seen some of the basic information of these companies, let's talk about their earnings results. So at the time of this recording, Royal Caribbean Cruise Lines hasn't actually reported Q1 earnings just yet. They are going to be doing that in a couple of days, but Norwegian Cruise Lines and Carnival Cruise Lines have. So if you'd like a follow-up video on Royal Caribbean Cruise Lines, definitely let me know in the comments. So starting with Norwegian Cruise Lines, the expected results for Q1 were negative 47 cents a share, and they ended up reporting negative 99 cents a share. So just to summarize quickly, how this generally works is Wall Street has an expected or an estimated EPS, and if a company surpasses expectations, it usually appreciates the stock's value. If they miss earnings, it usually depreciates the stock's value. Now, that is the general rule. This is not always the case. All investors have their own interpretations and expectations for an earnings call, and all investors will ultimately react differently to EPS results, or even the way that management answers certain questions on their earnings call. For instance, if a company beats EPS estimates but gives a gloomy outlook for their business, it may cause certain investors to sell off. So the difference between the estimated or the expected earnings and the actual reported earnings is called the earnings surprise. So earnings surprises are where the analysis should start, but not where it should end. Numbers aren't the be-all, end-all. Imagine that. Finance people saying numbers aren't everything. So as I mentioned at the time of this video, Royal Caribbean Cruise Lines has yet to report Q1 earnings. Their EPS estimates are currently at negative 58 cents a share, And considering Norwegian Cruise Lines reported negative 99 cents a share, and the fact that Royal Caribbean Cruise Lines has a larger market cap, meaning a larger workforce and are just a bigger company in general, it's possibly they're closer to that minus 99 cents a share than they are to minus 58 cents a share. The interesting thing about this peer group is that Carnival Cruise Lines, the largest cruise line company, actually posted positive EPS for Q1. Their expectations were 28 cents a share, but they reported 22 cents a share. Now, granted, they reported on February 29th, which was kind of before all the lockdown measures were put in place. Fear might have been starting to ramp up about the coronavirus, but technically the world wasn't on lockdown or shutdown just yet. Now, I want to talk about the debt-to-equity ratio, and the debt-to-equity ratio is an important ratio for these companies as they're going to need to take on additional debt to make it through these tough times. They're going to furlough employees, they're going to have to continue paying down their debt maturities, and how are they going to do that? By raising more debt. In fact, Carnival Cruise Lines, as I mentioned just at the beginning of this video, had just raised $17 billion via bond sales at a 12% yield, and that is an insane yield if you think about it. Your average yield on debt. I mean, I think anything over 4% is considered high, and this 12% is 3 times that. So anyways, debt to equity indicates how levered these companies are, how much debt they've taken on, meaning how much debt they have relative to their total assets. If we compare the cruise lines' debt to equity, Norwegian Cruise Lines has the highest at 1.04, meaning they have 1.044 times as much debt as they do have assets. So Royal Caribbean Cruise Lines is second with a debt to equity of 0.9072, and then Carnival Cruise Lines is the least levered with a debt to equity of 0.5326. Now, what does this all mean? Debt to equity is a relative measure of risk, so if this pandemic continues, people avoid cruise lines and traveling. Norwegian Cruise Lines is the most levered and most likely to be at the highest risk of bankruptcy. In other situations, or in most situations, debt should be and can be used to finance growth. However, in this case, this debt is a means of survival. So just to recap, Norwegian Cruise Lines is the most levered, and they also have the smallest market cap, so they're at the highest risk of bankruptcy of all 3 of these companies. Okay, so now if we get into the actual press releases and filings required by the SEC for the cruise line companies, I found something in Norwegian Cruise Lines release which was pretty interesting. You can see here that they actually state demand and bookings are actually still strong and growing starting in Q4 2020 through 2021. So if the $2.4 billion that they just raised can get them through the next 6+ months, we may see some of their cash flows start to normalize. Each company has identified various ways to cut costs, namely by reducing operating expenses, reducing capital expenditures, and improving their debt maturity profile. In layman terms, this basically means they're cutting payroll, furloughing employees, not building any boats, etc. As expected, Norwegian Cruise Lines lost a ton of money in Q1 2020, a whopping loss of $1.887 billion compared to $84 million in profit last year, Q1. Skipping straight to their balance sheet, I'm interested in their current ratio. Their current ratio is a means to see the company's short-term health or their ability to pay off their obligations in the next 12 months. You can get this ratio by dividing their current assets by their current liabilities. Norwegian's current ratio is 0.57 for Q1, and Norwegian Cruise Lines actually does state before COVID began that their bookings were actually up 7% before the world was shut down. It's not all glitz and glamour though, as they state they're burning through approximately $120 million in cash per month. Okay, now switching over to Carnival Cruise Lines here and diving into their quarterly results, the first thing to note is that they lost $781 million in Q1 2020 compared to generating a profit of $336 million last quarter. Now again, skipping straight to their balance sheet, you can see that their current ratio sits at 0.269, which is much worse than Norwegian Cruise Lines. Generally speaking, the higher the current ratio, the better the company is for the near term. As expected, their short-term borrowing has soared in order to remain afloat. As we continue into this uncertain world of COVID-19, we have no idea what the future of the cruise line industry might be. As mentioned earlier in this video, a couple companies are beginning to offer cruise vacations again in August 2020. Now jumping to Royal Caribbean Cruise Lines, as I mentioned earlier, RCL has yet to file their Q1 results, and they will actually be filing May 20th. And if you'd like to see a follow-up video when RCL reports their earnings, please let me know down in the comments. I think we can expect much of the same as what we saw in Norwegian Cruise Lines reports. Basically that they're going to be reporting a massive loss, they're going to be attempting to cut their costs all around, they're going to be trying to survive and raise debt basically to survive. So That's kind of what I expect. It's going to be a whopping amount of negative income. Anyways, if you want to see a follow-up video, definitely let me know in the comments, okay? So that kind of brings us to the conclusion of this video and what I actually think of these companies, and if you should actually be allocating a portion of your portfolio to cruise lines. As most people will probably tell you, these companies are at a high risk of bankruptcy, and their current ratio is well below 1, which already shows that they may not be able to sustain their business model without securing more cash through the issuance of debt. On top of that, worldwide quarantine orders materially prohibit this industry from generating revenue. They all have extremely high betas and are trading at all-time lows. A lot of their future is dependent on consumer behavior after governments worldwide ease restrictions. Will people be rushing to go out and travel? Who knows? But these companies do state there is bookings ramping up for Q4 2020, which is a positive sign. If it were my own money, I would only be allocating a small percentage to these companies as their future is up for speculation. So to me, these are speculative assets, and you're really trying to hit a home run with them because you can see they've lost 70 to 80%, okay? And it's not like they're going to jump back up 70 to 80% in a couple months. These companies are really just trying to survive right now. There's a high risk of bankruptcy. So, like I said, I would only be allocating a small percentage of my portfolio to these companies if I was going to do that. But please don't forget to assess your own risk tolerance before you put any of your money at risk. If this is money that you're not willing to lose, you should not be investing in these companies. They're extremely high risk, and there is that massive risk of bankruptcy, and the amount of debt that they're taking on right now is mountainous. Okay, so again, assess your own risk profile, and make sure you speak to a professional if you've never invested before, or just make sure you speak to a professional if you're not 100% sure what you're doing, okay? So that's all I have for you guys today. I hope you did enjoy. If you did enjoy, please don't forget to subscribe to the channel if you want to see more investment and personal finance content. Smash the like button to help me with that YouTube algorithm, and share the video with a friend if you learned something, okay? I will see you guys in the next video. Peace out.